Today, I would like to talk a bit on the medical insurance part where they talk of deductibles and also for co-insurance. So I believe you may have come across this term whenever maybe your agent have mentioned about it or you have read about it in your policy. So what is actually deductible? Deductible means you have to pay that certain amount before the balance of the fee is paid by the insurance company. For example, if let's say your medical plan deductible is 500 ringgit. So assuming if the fee is for the hospitalization is 100,000, you would have to pay that 500 ringgit before the balance is actually paid by the insurance company. For co-insurance is normally you share the fee with the insurance company. For example, the total bill is 100,000, for example. And if let's say you have a co-insurance of 20%, so you would have to pay 20% of that 100,000, which is 20,000, before the balance is paid by the insurance company, for example. So you will also come across some terms where they have a pre-retirement and also for post-retirement. So let's say, for example, during your pre-retirement, you do not actually need a very high or non-deductible. So you opt for maybe say, for example, 10,000 deductible, but you get to enjoy a lower premium for your insurance policy. But once you reach a certain age, let's say, for example, you reach age 60. So once you have reached your retirement, you are also worried, what if I need to pay this 10,000 deductible and I'm no longer working, for example, I do not have a regular income. So this is an option where once you have a post-retirement, the insurance company itself will actually revert your policy to a non-deductible plan without you having to go through the underwriting again. Because sometimes, when we actually reach age 60 itself, we may worry that we have a lot of health problems prior to this. So that is the advantage of pre and post retirement deductibles. All right. So how do we actually utilize deductibles or co-insurance to our advantage is sometimes in Malaysia, you are an employee with your company, you may actually have a company insurance plan bought by your employer. So let's say your employer bought your plan for 50,000 only. But of course, if you ask yourself, maybe 50,000 may not be a lot if it's a major operation. So sometimes we may opt for a personal insurance to cover ourselves, but at the same time, we may think that, but I already have a company insurance, maybe I should use my company insurance first. You can actually, most people would do is to opt for a higher co-insurance or deductible during the period where they're actively working. Let's say they already have 50,000 with their company, they can actually opt to their highest limit for deductible. Let's say I want to opt for 20,000. So when you opt for a 20,000 deductible, the life insurance company will actually say that since you opt for such a high deductible, we can actually offer you a higher discount for your premium. But also, it may come with a disadvantage if, let's say, your employment is not stable. This is where you may worry that what if suddenly I get retrenched, or I'm fired from my job, or I'm no longer working with this company, and maybe my new company, they offer lower coverage or they don't even offer at all. But I have opted for a 20,000 deductible. So this is where the danger is you will have to fork out this 20,000 first before you can actually claim the balance. So this is, I would say, something that you have to balance yourself. All right. So that's all for this video. I'll see you in the next video. Thank you.